Hello, I'm Tom Gosling, Executive Fellow at the European Corporate Governance Institute, and I'm here with Wilhelm Mohn, Global Head of Active Ownership at Norges Bank Investment Management, to discuss our series, Does Sustainable Investing Work? So, Wilhelm, thanks so much for joining me today. But before we get into the discussion, perhaps you could tell us a bit about Norges Bank Investment Management and your role in the organisation.
Thank you, and it's very nice to be invited to take part in this important conversation. Norges Bank Investment Management is the manager of the Norwegian Sovereign Wealth Fund. So we invest Norwegian oil revenues essentially all around the world, and over time taking this value from the North Sea, diversifying it into financial assets. And it's been going on for well over 2 decades now, and the fund, as of I think yesterday, was some 18,000, roughly 18,000 billion Norwegian kroner. So that's in today's exchange rate around 1.5 trillion US dollars or something like that. So that's the extent of it. We invest largely in listed companies. 70% is listed companies. We have about 1.5% ownership share in all listed companies in the world. In addition, we have an allocation in fixed income, government bonds, and corporate and unlisted real estate, and a very small but I think interesting and important strategic allocation to unlisted renewable infrastructure. And my role in the organization is to oversee our ownership activities, and we've defined that quite widely. So it starts actually with our principles and policies pertaining to corporate governance, sustainability, what we would like to see change at the market and company level, policy engagement, stewardship in its normal sense, and also ESG analytics. So we're sitting in sort of in between a risk function, which does the overall risk monitoring of the portfolio, and internal PMs that actually make investment decisions and organize this sort of hub on ownership responsibility also for voting. In addition to that, I oversee all our responsible investment reporting. We have an independent council of ethics, which will give us advice on companies for exclusion for ethical reasons. And we also do quite a lot of civil society interaction, and we support academic research. So it's a kind of a broad responsible investment department. Is what it is. Yeah.
Fantastic. And we're going to come back to a number of aspects of the way you approach things in this area. But I'd like to start off with your reactions to the series of articles that we put together with the European Corporate Governance Institute called Does Sustainable Investing Work? And I'll put a link to the original articles and my discussion with Harald Walkate in the show notes, which gives more on this. But I mean, very briefly, our review of the academic evidence around sustainable investing suggested that some of the conventional tools that are used struggle to create substantial real-world impact on environmental and social issues. So here we're talking about things like divestment from or engagement with dirty companies to make them improve, or focusing on tilting towards the shares or bonds of sustainable companies in order to support them. And what seems to be the case is that either the effects on the companies are too weak to be noticed at all, or, for example, with engagement, management only acts on them to a limited degree consistent with long-term value maximization. Or it could be that changes at the company level are just offset elsewhere in the system, for example, by competitors or state-owned actors undertaking the unsustainable activity instead. And so this led us to conclude that sustainable investors wanting to have impact need to be quite realistic about where they can have influence. And that perhaps means less focus on achieving outcomes directly and more on influencing the circumstances in which good outcomes can occur, which might mean, for example, influencing policy development or investee company lobbying activities. But so starting with your reactions to our work, let's start with a positive. What do you think we got right?
I think you get it broadly right. And I like the concept. I like the way you've sort of split it into the 3 parts and how everything to actually see actual change or actual impact, everything has to come together. And I also, because obviously this is somewhat maybe a negative reading on the opportunity set for responsible investment or sustainable investment, but I like then also, so I'd like to say up front as well, I like your I read it as a cautiously optimistic conclusion at the end, and these practical suggestions on how we should think about impact and achieving change, which I think are very timely and very interesting. I think investors should look at all the tools at their disposal. I think they should sort of think very carefully about their motivation, where they sit, how the market might react to it, time horizon, the dynamics, which will determine the speed and breadth at which sort of how change will happen. And then we think about it, and have for a long time thought about it then as a sort of a chain of tools. And then you put effort into the different points or places depending on the goal you're seeking. So this is kind of, you have to have a loose theory of change. And I think this is what you're contributing to. And I think I also, I mean, I'm not an academic myself, but I do like the sort of high threshold or your word of warning, whatever you'd like to say about, you know, you're focusing on a set of core articles that are peer reviewed, that where there is evidence, because as we know, there's a lot of maybe more anecdotal evidence, maybe a little bit more partial evidence out there to support, you know, underpin responsible investment for better or worse. But this is, yeah, I really like this contribution.
And so what do you think we got wrong?
Well, after saying that, I broadly like it. I mean, there's nothing specific, but I don't think you get anything wrong specifically. I wouldn't have been as dismissive, maybe, as you seem to be in your first papers about the value of marginal change. I mean, you come back to it, but I think marginal change is what we should expect. So affecting things on the margin is what we do as investors. And over time, I do think that can be quite impactful and additional in the pure sense. So it's more a question of emphasis, maybe, and thinking about the system through which change happens. As you said, you know, cost of capital, for example, that theoretical impact was always marginal. It couldn't be anything other than marginal. So that's how we should evaluate those strategies. And then on the more agency-based impact channels, stewardship and engagement, and working for more sort of aligned investments between investors and companies, I think the motivation is very, very powerful and clear. But again, you know, you're running up against these economic constraints in the real world, so you should be aware of it. Yeah. So I don't think you get it wrong, but I'm positive about the marginal change.
Questions.
I mean, that's what we're sort of going for, really. I think you know, ensuring that the pie grows in the long term as much as possible is, at least for us, that's the game. You know, climate change is a great example of all sort of three things. Very real risk from a financial point of view as well. The winners, you know, we don't know about we can't predict next year, but we kind of probably know a little bit about what might sort of have to happen through the 30s for this to be managed. So the time dimension again then for ownership is just, you know, it's long term. We know the economic motivation is getting clearer, but we also know that policy support is needed, and it's unreasonable or unrealistic to kind of ask companies to change on their own. So that's how you need to think about it.
And do you think there are any important areas that we just missed completely that need to be taken into account?
I think it's very hard to probably model or conceptualize even, maybe, or build structure around it, but impossible to prove, maybe. But these interactions, I'm very interested in the interactions between the strategies at different levels. How you create a virtuous cycle between a company decision and a policy goal, for example. How you do get the most out of an investment decision and ownership activities together. We have this, I mentioned as I introduced myself, we have a council on ethics, which very, very specifically go out and recommend transparently, openly, companies for exclusion from as a norm space, criteria set by the Norwegian government, very, very clear. But that transparency, actually, we know, anecdotally at least, does contribute to change, right? And that's not even what we hope to do through that activity. We are actually specifically just essentially cutting any link between us and the company. But we know that companies react to it. So I think there are interactions there, and then transparency in its own right. You know, firms might be getting more transparent. Maybe that's not leading to anything, but there could be second order effects with peers. You know, peers might react to that transparency, and you know, how do you model that? And then transparency as well gives you more well-functioning markets, and what are the second order effects of that? So I think, yeah, understanding those things, the paths and the interactions are very important. And one other thing actually as well, I think you say it, maybe and maybe this is not exactly the same argument, well, it's possibly the opposite argument. I think when we look at outcomes and what we try to measure at company level in particular, we should be very specific and look at the concrete stuff. So actually emissions reductions or shifting investments or more green patents, whatever it may be, rather than a sort of policy or a report, because that's not evidence of much.
Yeah. I think your point about system effects is very important, and they are of their nature, they're more difficult to prove and demonstrate. But certainly our conclusion from doing the work is that actually that's probably where the most interesting impacts arise, but also the most difficult to demonstrate.
Almost impossible. But you kind of have to, I think there's a strong reason to, it's conceptually quite strong. It's possible to kind of, you can understand it, but probably not prove it.
Yeah, for sure. And I don't think that means that we shouldn't try to do stuff in those areas. But I think that I think our conclusion was that if you think that what you're trying to do is influence the system as opposed to directly achieve outcomes, and that probably leads you to slightly different types of activity. And I think that's where, I mean, I like your interpretation of what we've done as cautiously optimistic, because I think the motivation of it was to really try and identify the areas where investors can be effective. And as you say, I think our conclusion was that inevitably that's sort of at the margin. So effects need to be calibrated in that way. And I think that brings us quite nicely actually onto how you think about responsible investment at NBIM. Can we start with your mandate? So in your responsible investment report, you state right up front that the investment objective of the fund is to achieve the highest possible return after costs, given an acceptable level of risk. So that's a very kind of core financial mandate. But then you say within the scope of this objective, the fund shall be managed responsibly. What does it mean to you to manage the fund responsibly?
Yes, there's at least two dimensions to it, maybe three. So one is, it points straight back to the long-term objective. So there is a sort of responsibility element of that, and then there's a more, so shall we say, norms-based rationale to do with the integrity of the fund model and making sure that this is actually managed in a way that's can be trusted with our stakeholders in the Norwegian government, and ensure that we have a sort of stable investment framework, and then ultimately also in a way that's responding to standards for responsible business conduct, such as the OSD guidelines. But we had a report in 2020, an independent commission reported to the Norwegian Ministry of Finance, and they looked at our sort of the values elements of this, and what they said very clearly, which again built on actually a report from 2003, but they said that they said it even more clearly in 2020 that there are two primary ethical obligations of the fund, and one is to actually achieve good return for future generations. So that's an ethical obligation in itself, and that kind of speaks to, I don't know, maybe am I in the Protestant or something like that? That's the kind of, there's a long history of that in the world and in literature as well, I think, particularly looking at this. And then it's about not being invested in some companies that contribute to very, very unethical matters. But if you think at the core bit, and certainly the core bit of what we do when we consider ownership or when we consider risks and opportunities, it's the long-term return element of it. So being responsible is to try, and it's harder to do it in practice than, so again, conceptually, is to try to address these two things, essentially, externalities and agency challenges, because those are the two things that are possibly affecting those are the two things you would like to achieve: the integration of internalization of externalities and the reduction of the agency challenges for this portfolio, which is essentially a portfolio of the world, to be maximized in the long term. And then within that, you can also, put the information to good use and maybe achieve something in a more relative sense on a more short-term basis. So it's really about efficient markets, good corporate governance, disalignment of interest, minority shareholder rights, the biggest sustainability risks such as climate change, and then the responsible business conduct, also underpinning it all to ensure we have both credibility as the long-term investor and legitimacy. because for us, this strategy must be transparent, it must be trusted, and it must have very solid foundations. It's unanimously supported in the Norwegian Parliament, and we have a very different system to the UK system. So we have proportional representation and a plethora of parties in Parliament and coalitions of all sorts of combinations, and they're actually all of them in support of this, and that's important because what would really put us at risk is something which at the wrong time reduced our ability to diversify and harvest the equity risk premium, so essentially a fire sale or some description or something like that, because that is really what we do for the future generations of Norwegians. We're trying to harvest that premium.
I'd like to dig a little bit into one part of that aspect of responsible investing, which is about trying to have impact and bring about change in the way that companies operate and the way the system operates. And my observation over the last few years is that you've trended a little bit more towards that objective as opposed to just a classical kind of climate risk or investment risk perspective. And as evidence for that, in your climate action plan, you're clear that you see an orderly transition as being beneficial to your portfolio relative to a disruptive one. And a couple of years ago, you introduced an engage to change approach to help push firms onto a net zero trajectory. So am I right that you now see part of your responsible investment role as having this real world impact on sustainability outcomes? And if so, is that just still motivated by a broader financial objective through the channel of supporting wider economic health, or is there something else behind it?
No, you are right. And I think, the role originates from our motivation, which is long-term return. So it's not a role in itself or a responsibility in and of itself. It is something we would need to try to achieve in order to increase the return of our portfolio and avoid significant risks, because all models show that all our models show that if we don't have a climate transition that is both orderly and sufficiently ambitious, there is a lot of value at risk here. So it is motivated in that long-term economic interest. The question is, how do you deal with it? We had another public report which led to the change in mandate and to our climate action plan, and I think they said a lot of interesting things. But one thing they said very, very clearly is that you can't have a 2-degree alignment of this portfolio. Doesn't make any sense unless the world is on a 2-degree path. Because so that's your answer. And if you need that also to have the environment where economic return is well, I wouldn't say maximize, because that's sort of the wrong way of thinking about it. But where growth is most secure, then you need to think about how you can achieve that, and that means working at system level if you can, with all the caveats that we can get back to, and then through companies to try and support them as well. You might, and it's very much a universal owner motivation.
And so, how do you think about creating that impact at the system level and at the company level? Do you see one channel as being more effective than the other in terms of this goal of bringing about system change, or are they simply complementary?
They're complementary for sure. Market change is always first best for us, because by virtue of what we are, we are a long only, essentially passive investor, 125 basis points of tracking error from a global benchmark. So that's first best, but is it achievable? That's the other question. It's also more resource efficient. Working at market level, you have however many counterparties. It's not 8,800 companies. So that's clear. You can very clearly maybe pinpoint things that you're interested to see. Disclosure requirements, expectations, could be even things like a global carbon price, whatever it may be. But there are these market-wide sort of to do with the level playing field and efficient framework and things that you can certainly work towards. But then clearly some of these issues are very company specific as well. So you can't deal with it all through a market route, but you can try and contribute to a playing field that is efficient. and useful for us as a long-term global investor. And that's the focus. We can also work country level. We do, if the implementation of it is more country level, but our thinking is global, I think is fair to say. And also just supporting global solutions in itself makes a lot of sense for the type of investor we are, and actually probably also for the type of small open economy we're coming out of. But it's most effective to think of it as an interaction and have that theory of change. And then, you know, there are sort of practical things at the market level as well. You know, how do you have impact? You need a relationship. You need to build that. It's the same with companies. You need expertise. You need to have something that regulators are interested in. We would never say that we couldn't have. I don't think we would have a credible expertise on industrial policy or climate science as such. So you need to come in where you clearly have a clear interest as an investor and something to contribute, governance, sustainability, but within your own framework. And then there is access. So I think we are large enough probably to have quite good access by and large. But again, it's not a given.
Yeah, I think that point about relevant expertise is really important. I think investors are much more credible in guiding governments as to what is required in order to trigger investment than they are veering into more kind of political policy areas. But you are very clear, and in fact, I think a comment that you made a few moments ago really resonated with me. That what does it mean to have a 2-degree aligned portfolio in a world that isn't 2-degree aligned? And you're pretty clear that in your responsible investment report that major sustainability challenges need the right government policy to set incentives for companies. In that context, how do you think about what you hope to achieve in the absence of appropriate government policy, and what's your theory of change that supports your action?
So, we are absolutely clear that without policy, there is a limit. There are clear limits, but it doesn't mean to say that the policy is the sort of sole determinant of corporate activity on climate change. It's the most important, probably. But corporations have a lot of agency. They're not just absorbers and responders to government policies. They interact. There is a sort of path dependency argument, which I always thought is quite a strong one. There are clearly behavioral biases. Company decision makers do not, at least to my knowledge, they don't have perfect foresight when they assess an investment or a technology or whatever. So to be part of a clear voice and a friend and challenger of the board on matters where you believe that you know where your interests lie, I think that can be positive in its own right. When we engage with the companies, the first thing we want to understand is how they've sort of thought about maximizing their climate ambition based on the conditions that they face, and then also understanding what is needed for that ambition to be increased. So there's an interaction there as well, and I think it's the forward-looking bit that's the most interesting to any investors, and also probably where we have the most scope to affect change, because those are the decisions that they're about future. So again, government policy is a key driver of that. But it could be other things. It could be cost reductions that come from scaling up an approach, or technology. There are new markets for low carbon products. You have these. It's not probably happening a lot yet, but you have these sort of interesting customer supply relationships that can be a kind of in lieu of a policy framework, advanced market commitments. Those things can kind of create the certainty or the conditions you need to facilitate more long-term decisions, which again can underpin government policy and make it more credible. Same with technical things. What is actually green steel? So getting a standard for that is not really a policy decision, but it might, if you know what it is, then customers will maybe on margin more likely to go for it. So I think there's a lot there that you can work on in absence of policy, and then you have the sort of structural issues like well, you mentioned lobbying. We'll get back to it, but when it's about shaping the future structures and incentives, we have very clear interests, and it's much clearer and much more. you're not asking companies to bear losses or to do things that are not in their interest. You're simply asking them not to work against a future in everybody's interest.
I think that comes back to something you said earlier, I think, doesn't it, about the fact that companies have a lot of agency. So there's not a sort of a single path to maximizing shareholder value at the company level, and lots of choices directors have. And I guess what you're saying is that you're trying to create a different emphasis amongst directors about how they think about creating value. One area that's rising up the agenda quite a lot for asset owners is this question of policy engagement and corporate lobby. Is this idea that investors have a role in ensuring that portfolio companies lobby in a way that's aligned with the Paris goals, or at least in line with their stated commitments to the Paris goals. And so, for example, we've recently had a resolution put forward at Toyota asking them to produce an annual report on alignment of lobbying activities. What do you think about this approach to corporate lobbying, and what are some of the pitfalls or limitations of investor action in this area?
I think this is the most kind of straightforward engagement issue we have, actually. I mean, it was first highlighted. The colleague who highlighted this for the first time is still with us, and we did it the first time in 2006. It was actually our first mention, in addition to sort of disclosure. It was the first mention under when we first started to focus on climate change back in 2006, because you have this very straightforward rationale. We have this interest in a long-term sustainable future, and asking companies not to work against that is not a very complex ask. It's about shaping the future, not the economic decisions or competitive realities today. So it's making plans and investments needed to succeed in a world that is positive for all. And if you don't do that, you're kind of undermining most of your shareholders, probably society at large as such. And probably for most large companies, you're actually undermining yourself ultimately as well. It's just a question of time. So I think lobbying is an important issue. Maybe it can never be the sole issue. I don't think it's probably decisive enough as such, but it's a very important issue, and having transparent lobbying and more transparent sort of political interaction by corporates overall is an issue we will continue to focus on. Probably an area where we can be more clear, more vocal, actually, even though we have this long-term focus on it.
Interesting. And so, I mean, just to finish then, I mean, I'd say we're going through a period with sustainable investing where it's coming under more scrutiny about whether it's living up to the twin promises of delivering returns and impact. And I think that, I mean, Norges Bank Investment Management, by the nature of your mandate and purpose, I think you have the luxury of taking a broader and more dispassionate view about what's happening across the market than some other firms that are in an asset gathering mode are able to do. What's your view on a couple of critical issues that sustainable investing professionals need to focus on over the next few years?
Yeah, no, I think we probably have that ability. I think this idea of ESG as a performance driver that was driven by fund flows, possibly. There was a lot of interest. It was cooling down, so kind of some of these things are not too surprising. I think the sort of focus again on ESG and the kind of critical focus is there are many players and many kind of drivers of it, but thinking carefully about what works and what doesn't work, I think it's important, and that's probably also one of the things we will have to deal with going forward. We should think about what our role is. It's naive to think that we don't have a role to play, but we need to think about how avoiding backsliding on an issue, for example, such as the energy transition, for example, or investors' role in that, irrespective of the sort of points around greenwashing and skepticism about some claims. I mean, that is something you do at your peril. So I think holding the course is very important. I think also this, to your point about sort of dispassionately looking at this, it's looking 10 years out, I think I already said it actually, but you know, we know that direction of travel. So we know more and more about the risks and the solutions and the opportunities. So we kind of, I still think we're standing in the light. I don't think, I think the renewed focus on this is a positive. I think we know which companies probably are best placed more and more to benefit from a sustainable future, and we should also think about how we can make the rest of them catch up with the leaders. In terms of topics, you know, there are a couple of things that are coming to the fore. I think nature risk in particular, and how it comes together with climate change, both as a sort of manifestation of the risks, but also the solution space. Even social issues in the energy transition. So thinking about how those material topics fit in with the more advanced discussion on transition plans. I think that will be important. And then I think we should never lose sight of the sort of core channel of it all, which is, you know, governance and incentives. So, you know, ultimately for us is still the well-functioning board. And in the world with increasing challenges and opportunities, we need to focus on which boards are ensuring their companies can negotiate that world, and understanding what works and what doesn't work then. So looking at the effectiveness of the board itself, understanding how decisions are made, understanding, you know, or holding board members to account. I think that's still, you know, that's still the sort of bread and butter of this work. And then I think the last one is, and again, maybe very much relevant or very related to what we've talked about today. It's about being open about the things that don't work, because I think that's been part of the sort of failure as well. Not failure, but over enthusiasm maybe. Or it's so nice to think that we are on a linear path where you know, everything. If we just know about it and we are clear about it, we will get there. But that's not how it works. So having more structure around what works and what doesn't work is very welcome, and I think that's why this is an interesting and timely discussion too.
Wilhelm, thanks so much for taking the time to speak to me today. It's been a fascinating discussion.
Thank you very much. It was very interesting.